But it is Tuesday, and it is Technical Tuesday. We're going to bring out the charts, and today we're going to take a look at Canadian stocks. We're going to look at commodities, but we're also looking at the U.S. buck. Our guest for this week's edition of Technical Tuesdays is J.C. Parets. He's president and founder of Eagle Bay Capital and editor of the technical analysis blog, allstarcharts.com. He's in New York. J.C., thanks for joining us. We're going to kick it off with the U.S. dollar. We have a look at something you provided us with. It's a longer-term look at sentiment towards the big dollar, as it's called, and sentiment is pretty muted. Tell us what this chart is. You call it a squeeze in terms of these sentiment indicators.
Yes, that's right. So again, thanks for having me on. But yeah, this really catches our attention. When you have this many bears, it really stands out. So what we like to do, I mean, everybody gets a poll these days, you know, retail investors and fund managers. So what we try to do is we try to kind of get an aggregate of all of them and really smooth it out over a year and kind of see where sentiment is based on where it's been over the previous year. And really nobody thinks that the dollar is going higher. Everyone is waiting for a big break. And if you look at the United States dollar index, and this is the one that's made up of the 6 major currencies, and you see a major big textbook topping pattern. Everybody can see it. And last Thursday, we had a brief breakdown below that neckline, if you will, that key level of support where we've seen demand, and it briefly broke intraday before that key reversal. So when you see a key reversal at major support, when everybody's waiting for the break, I'd rather take the other side of that trade, and that's exactly what I think is happening here, and I think we squeeze a lot higher in the dollar index.
So a lot higher in the dollar. We're just looking at the UUP, which is one way to participate in that basket of currencies in favor of the U.S. dollar. What does that mean for commodities if the U.S. dollar does rise? That suggests that commodities go the other way.
Yeah, in theory, for sure. Commodities have been a big winner so far this year, but there's been two different trades in the commodity market. It hasn't come from the base metals. I mean, most recently, over the last few days, sure, we've seen some base metal strength, but really for the year, it's come from the agricultural names, coffee, corn, you know, some of the stuff, Frances, you and I have been talking about, cotton, sugar looks great today also. That's really where the strength has been, lean hogs, cattle, things of that nature, not so much from the base metals. So I think that trend can really continue with the agricultural names, and really the precious metals, it's not really a place that we want to be. It's really just a mess. You and I, we've talked about that. If we're going to be in any metal at all, I'd rather be in palladium. So overall, it would be disingenuous for me to say, oh, just because the dollar is going to rally, all commodities are going to be weak. I think some will be weak and some will do well.
What about stocks? Let's take a look at the stock market. The S&P 500 new high, the Dow, the transports all at new high. The small cap, the NASDAQ, they're picking up some steam. We're just going to run through charts for our viewers, but where do you sit on U.S. equities? And then we'll drill down into some sectors.
Sure. We came into the year bearish U.S. equities. I really didn't think there was any reason to be long the overall averages, and we're essentially flat. And depending on what index you're looking at, whether it be the Russell 2000 or the NASDAQ or the Dow, some of them are actually down year to date. So for argument's sake, let's just say that we're flat for the year. We're making some nominal new highs. But really what worries me, Frances, is the internals of the market. When you see the S&P and the Dow making new highs, you want to see more and more stocks participating. You want to see the participation broadening, and we're seeing the opposite. We've been seeing it all year. With every new high in the S&P, fewer stocks on the New York Stock Exchange are hitting new highs. That for sure is worrisome. That bearish divergence. We're seeing money flowing into value as opposed to growth. This is the first time we've seen this since the market bottomed at the end of 2008, early 2009. Again, something else that's worrisome. Also, the sector rotation. Money's flowing into energy and utilities. Those are the best 2 sectors for the year. These are late cycle sectors. These are the names that tend to do well at the end of bull markets. And that's where the strength is. And it's not where the strength is in the middle and early bull markets, which is financials and discretionaries. In fact, those are the 2 worst performing sectors for the year. So all of these things, all of the rotation that we're seeing, the internals, the breadth of the market breaking down, sure, can we make new nominal highs, maybe get up a little bit over 1900 or so, 1910 in the S&P? Sure, and I think that that's a fade.
And that's a fade. That means a sell. Just speaking about that kind of rotation, you mentioned discretionary. We have a graph, is a relative graph of the consumer discretionary versus the staples. And in this instance, the falling line means that discretionary is giving away back to the staples, if I'm reading that correct. Is that more of that concern for you?
Absolutely. You know, Frances, fortunately for us, we have the ability to just go to cash if we don't want to be in stocks. You know, we have that ability. But a lot of long-only fund managers and mutual funds, they're not allowed to do that. They have to allocate assets. They have to be long, and that's big-time money. So would you rather be in discretionaries like home builders and retailers and automobiles and things of that nature? Or would you rather be in consumer staples? In other words, things that are going to do well regardless of where the economy is. Things like Colgate-Palmolive and Procter & Gamble, cigarettes, beer, Coca-Cola, things of that nature. If you're a fund manager right now, they're putting the money into the safer, the staples, and not into the more aggressive consumer discretionaries. And again, that's part of the rotation that we're seeing that's worrisome as well. And it makes sense to what we're seeing elsewhere. It makes perfect sense.
We're going to show another graph because this is a Canadian business news station. We're going to look at the EWC, which is the Canadian ETF or Canadian stocks, relative to the SPDR, which is the S&P 500. You've drawn the line in for us. It's broken a downtrend. You like Canadian stocks?
I do. I really do. I like them over U.S. stocks for sure. You know, if you look at EWC specifically on its own, you know, we've had a nice little base over the last couple of years. Really nice, and now we're making new highs. So we know, and the market is telling us that that overhead supply that we've seen over the last couple of years in this 30-level area of EWC, we've now been broken. So that the market is telling us that the sellers are just exhausted up here and the buyers are now in control. I think we could see a 10, 12, 13% move higher in EWC back to those highs in 2011. I wouldn't be surprised at all. So, you know, if you're long this market, you really want to only be long above those highs. So from a risk-reward standpoint, I like it. It's definitely attractive. A
lot of Canadians are saying, I like to say, from your lips to God's ears on that call. Sure. Finally, we're going to end with the bonds, which you've had a good call so far this year. You've stayed long. The bond market, nobody called that. You were there. What's this say to us now? We're kind of in that range on yield.
Frances, I think you hit the nail right on the head. You said nobody liked it. Nobody wanted to be in bonds coming into the beginning of the year. Obviously, you and I talked about it. I loved them, and that was one of the reasons. We're seeing the same thing in the dollar. You know, anybody who likes U.S. dollars? I don't. Everybody's, you know, trying to sell them. I love them. We're seeing something very similar. So as far as bonds, I think the trend continues, right? The trend is your friend. The trend is higher in the bond market. I think rates continue to fall. And I want to talk specifically real quick about the 10-year, because although the 30-year is continuing to make new lows, new lows we've already broken down since the beginning of the year, but the 10-year is still stuck in this range, this 2.6 to 2.8 area. And I think ultimately it resolves itself to the downside, and we head down below 2.4 for sure. I think it's only a matter of time. I saw, you know, before I came to the NASDAQ, I saw rates were getting hit hard this morning. I'm not sure if that's still the case, but my theory and my thesis coming into the year, and it still is that rates continue to come down. Again, everybody loves them. Everybody thinks rates have to go up because they can't go any lower. And I think that's completely wrong. I think they absolutely can go lower.
JC, yields, the 10-year yields down 4 basis points on those retail sales numbers this morning. We'll continue to follow it all with you. Thanks for joining us.
Thanks for having me.
JC Parets, president and founder of Eagle Bay Capital and editor of Technical Analysis, a blog, allstarcharts.com. He was in New York City.